Hi, and welcome again to the CDFM study group. My name is Helen Thomas. Today we're going to be covering CDFM Module 3.3, which is entitled Accounting. So we're going to look at the accounting functions, accounting codes that are necessary in the financial management field. So let's begin with page 3.3.5 and look at the three types of accounting. If you look at the slide at the top of page 5, it says Federal Accounting Framework, Budgetary Accounting, Financial Accounting, and Managerial Cost Accounting. What I want to pinpoint something to you is if you look at that, what I just read, and also go to the first paragraph, you notice it says on the first paragraph, Accounting Introduction, the Federal Accounting Framework includes three accounting systems: budgetary accounting, proprietary accounting, and managerial cost accounting. So you see a difference in word use there. Instead of using financial accounting, now they use the word proprietary. So understand that financial equal proprietary accounting. It's the same thing. So don't get confused if they ask for the types of accounting and you happen to see budgetary, proprietary, and managerial cost accounting. Understand that proprietary is the same thing as financial accounting. All right, so now that's set. Let's go to page 3.3.7, a quick snapshot of the three types of federal financial statements. They are the balance sheet, the statement of net cost, and the statement of change in net position. So those are going to become important in a little bit as we are introduced to the balance sheet. We're going to look at how the balance sheet interrelates with the net cost and the net change in position. So you have some examples on page 8, 9, and 10 of what each one of those federal statements look like. On page 11, you have some of the laws associated with the accounting function of financial management. So make sure that you review the 1921 Budget and Accounting Act. The GAO was established. We also have the Office of Management and Budget, which was established during the 1921. So you read through that. Also covering the last one on page 11, the 1982 Federal Managers Financial Integrity Act. So these are some of the laws that are quite popular. No matter which module you study, you have to know the Federal Managers Financial Integrity Act that required each agency to establish internal control programs within their organization. So kind of know which law and what was the result of that law and what changes were instituted because of that law. It carries over on page 12 where it talks about the 1990 Chief Financial Officers Act. So we were talking about on page 12 the Chief Financial Officers Act of 1990. That's also an important act or important law for us to know as financial managers, because that was the law that established the requirement for each agency to have auditable financial statement. So this was the law since back in 1990 is the reason that we have GFIPs today. So again, review all of these laws and acts. Don't focus on all the words, just what is the key item, the key thing that is generated from that particular law. On page 13, you look at the federal financial management and the three major agencies involved. Office of Management and Budget, because they're the resource manager for the executive branch or the president. We talked about GAO, that Independent Government Accountability Office that's responsible for auditing the executive branch. Then you have Department of the Treasury. That's our nation's bank. That's where we get our money from. So they play an important role. And the Federal Accounting Standards Advisory Board. They help establish the policies and procedures that we have to adhere to under the accounting umbrella. Moving over to page 15, you see when it comes to implementing these accounting standards, you have the same three agencies on page 15. Government Accountability Office, Department of the Treasury, and the Office of Management and Budget, OMB. Now we're going to jump over to page 22, 3.3.22, DoD Financial Management. First of all, the principal advisor to the Secretary of Defense when it comes to budgetary matters or fiscal matters is the Undersecretary of Defense Comptroller, USD Comptroller. Know that individual. That's the resource manager or the CFO, Chief Financial Officer for the Department of Defense, is the USD Comptroller. When you read through that whole paragraph, that's the most important thing there. The second part, the DFAS, Defense Finance and Accounting Service, is the accounting entity for the DoD, Department of Defense, and maintains the general ledger and all the accounting data for the Department of Defense. So you have the USD Comptroller, which is the principal advisor in budgetary and fiscal matters, and then you have the agency or the services provided by DFAS for accounting. And when we talked about finance the last time, they are also responsible for finance. And it's in their name, Defense, Finance, and Accounting. So that's the agency. On page 23, we also talked about the DoD 7000.14R is the DoD regulation, Financial Management Regulation, DoD FMR. So you look at all the volumes, make sure that you review them. Figure out a way. You have them in order, 1, 3, 4, 6A, 6B. It's because I did have some students who said they had to memorize some of these. So make sure you review the volumes. Don't memorize the whole paragraph or the section, but just kind of memorize the key words associated with that. Page 24, 25. 24 talks about the general types of government funds. So general funds, specific funds, public enterprise funds, and intra-government, interrelated. So some other ones, trust funds. So read each one of those, understand what they are, what they're used for, because they're very important. Specific to the Department of Defense is on page 25. We have appropriated funds, reimbursable. Like when we use our MIPers and I use my money to buy your thing, you give me, reimburse me. Reimbursable, revolving funds. Those revolving funds is equating to that working capital fund that we talked about numerous times before. Those are the funds that do not expire, but they still have restrictions and rules that they have to follow. Trust funds, some example of a trust fund. Your military retirement fund and foreign military sales. So that's money that's being put aside in a trust for use later. And NAF funds, non-appropriated funds. So those are the types of government funds used by the Department of Defense. So more importantly, make sure you understand page 25 because it directly relates to the Department of Defense. Next, the categories of appropriations. And we've seen these numerous times, but I'll still read over them. Annual, every year, 1 year. Multi-year appropriations, RDT&E, procurement, military constructions. No year appropriations is the same thing as the revolving fund, is the same thing as working capital funds. Those are different terms meaning the same thing. Same things. No year, working capital fund, or the one that does not expire. So it's a revolving fund. On page 27, you see the table of the DoD appropriations, and we've seen this. Your MILPERS and O&M are 1 year appropriation. That's your annual. You have your RDT&E is 2 year, procurement 3 year, military construction and shipbuilding and conversion Navy is 5-year appropriations. You have to know that because, again, you need to know if we're talking about RDT&E funds, those funds are good for 2 years to spend, and then an additional 5 years, they're in the expired state when you can make adjustments. And then on the 6th year, after that, then that account is closed. So even though we are in a new fiscal year, we're still closing out bills 4 or 5 years in the past. So they always overlap. And then we go into page 27, where it talks about flow of resources. That's our flow of funds. We've talked about that before. Your commitments, we commit administrative reservation of funds. That means we set the money aside. I want to go out to lunch, so I'm going to take $20 and I'm going to put it in my purse. I'm not going to use it. Obligation, I go out to eat and I order the food, I eat the food. So now I'm obligated to pay for the food. Obligation is a legal reservation of funds. And finally, disbursement, or in this term, it's used as outlays. Outlays is when the money, so I give that waiter or waitress my $20 to pay for my bill. They take out the amount of the bill and I get the change back. So in the same type of scenario, I'm just trying to give you an example of how it works. It's similar to how we pay our bills. So we commit, obligate, and we also outlay or disperse those funds. Ensure that, let's see, on the bottom of page 28, top of page 29, they talk about the MIPR, Military Interdepartmental Purchase Request. So between agencies, we can have contracts where one agency will perform the job for another and then determining who pays for it. Know the difference between a project order and an Economy Act order. The main concern is a project order can cross fiscal year. Economy Act order, which is typically between DoD agencies, cannot cross fiscal year. So you have to deobligate the funds. So if it cannot cross fiscal year with the Economy Act, that means at the end of that fiscal year, I have to deobligate those funds. Project orders are those that because it's not adhered to that annual or fiscal year, it means it can cross. That means I do not deobligate those funds. So the most important part of this accounting section is on page 30. Starts on page 30, the chart of accounts. We're going to be referring this chart because you're going to need to memorize the chart. And by memorizing the chart, it will also help you to remember the formulas associated with this section. Again, on the exam, they will not give you the formula. They will not allow you to use a calculator. So you have to know what formula to use. If they say calculate the balance sheet for these transaction, or they say which transaction is a liability, which is an asset. And so on page 30, you notice account codes 1,000 all the way to 8,000. The title is the name, that is the type of accounting data, and the normal balance to the far right tells you whether that normal balance is a debit or a credit to your account. And so we're going to look at those shortly. So I will continuously refer back to page 30, but let's move on to page 31. So we said there were 3 types of accounting: budgetary, financial or proprietary, and managerial cost accounting. So on page 31, they're discussing the budgetary accounting. The good thing about budgetary is all the budgetary related items start with a 4. So it's 4,000. So if you look on the charts on the top of page 31, you see resources equals status of resources. But all of those are 4,000. If you go back to the chart on page 30, account code 4,000 is the budgetary transaction. So if nothing else, you learn The budgetary is 4,000. So you've learned the accounting code 4,000 is associated with all your budgetary transactions. Resources equal status of that resource. Additionally, we talked about the statements, the federal financial statements. We said the balance sheet and the statement of net costs are two of them. So on the top of page 32, you see the formulas for the balance sheet. Assets equals liabilities plus net position. Again, the formula for the balance sheet, your assets must equal to your liability plus net position. So if you flip back to page 30, that chart, you see in the title assets, the next one under that is liability, the next one is net position. That's your 1,000, 2,000, and 3,000. So those are the account codes. So by knowing that my 1,000 equals 2,000 plus the 3,000, I've learned the formula for the balance sheet. Again, the formula for the balance sheet is assets equal liabilities plus net position. So that's my 1,000 code equals 2,000 plus the 3,000. So that means, in accounting, both sides of the equation must be equal to each other. So what's that saying is that after you pull all your assets, add them up, it must equal to all of your liabilities plus your net position. They should balance the same number on both sides of your accounting T chart. Next, the statement of net cost is calculated by taking your expenses minus your revenue, and that will give you your net cost. Again, expenses minus revenue equal net cost. So if you go back to the chart on page 30, you see expenses is 6,000 minus, you go back up, minus revenues is 5,000 equals your net position. So if they tell you to calculate the net position or net cost rather of your whatever transactions they give you, you're going to need to pull out the data for expenses minus your data for revenue, it equals your net cost. So on the chart on page 30, we've learned assets equal liability plus net position. So we've learned accounting code 1,000, 2,000, 3,000. We begin with the balance sheet or the budgetary, which was 4,000. And then we just said that your net cost is taking your 6,000, which is expenses, minus 5,000, which is revenue, and that will give me my statement of net cost. And then all you're left with now is 7,000 gains and losses, and 8,000 is your memorandum. On the chart, then you just have to, you look at the normal balance. So your assets and your expenses are both debit balance. Your budgetary and gains and losses. So budgetary, sound like I got some money. Gains, losses, I'm dealing with my budget. So those can be either a credit or a debit, both. And all the other ones, minus the memorandum, is credit balance. So that will help you to not only memorize the chart, but also it will help you to remember the equations or the formulas associated with each. Because chances are you'll get the data for all of it, and they might simply tell you, calculate the statement of net cost and what will be the result. So you only need your expense minus revenue, whatever number, even if you don't know whatever it's called. If it starts with a 6,000, that's your expense. If it starts with a 5,000, that's your revenue. 6,000 minus your 5,000 will give you a statement of net cost. Assets equal liability plus net position is what you use to calculate the balance sheet, and so forth. So whatever number starts with a 1,000 equals your 2,000 plus your 3,000 accounting code. From page 33 to 35, that is the floor fund. So what it's starting with is when Congress appropriates the money and OMB apportions and the Treasury issues a Treasury warrant, the two things that always happen once we get an appropriation, then it's talking about the accounting transactions that occur at each one of those stages. So it goes into transaction 1, appropriations, transaction 2, OMB apportionment process. Number 3, DOD gives us allotment. Number 4, we commit. Number 5, obligate. Number 6, we receive the items that we ordered. And then number 7, payment of invoice. So we receive the items, acknowledge, and then we pay the invoice for that bill. So what you have to look for is which transaction requires a budgetary, a proprietary, or both. And if you go through, starting on page 33, you'll see the first transaction, which is appropriations. It requires both a proprietary and a budgetary entry. You can see that on the top of page 33. Transaction 2, 3, 4, 5, all require budgetary alone. Transaction 6, receipt of the material. So I ordered some boxes of paper. The paper comes in. I've received them, what I ordered. That requires a budgetary and 3 proprietary, but just say budgetary and proprietary. And the last transaction, number 7, when I pay the invoice, that also requires budgetary and proprietary entry. So that's kind of how you figure out, well, which one requires what transaction is based on the first step, the 6th, and the 7th step, the 2 last ones. And you just got to know apportionment, appropriation, apportionment, allotment, commit, obligate, receive the items, pay my bill. Okay, so just kind of learn the steps that way, and then it'll be easier for you to remember whether it requires a budgetary or financial proprietary entry. So on page 39, you have some definitions. Selected assets account can be fund balance with the Treasury. What do I have left in the Treasury? It's simply what that's saying. Undistributed disbursement, interest funds, you can read through all of that on page 39. 40 talks about what's considered a tangible asset, have an estimated life cycle of more than 2 or more years, and so forth. So that's more reading through those information. Heritage, stewardship of land, etc., etc. Page 42 talks more again about the federal financial reporting, the balance sheet, statement of net cost. Remember the formula. Statement of change in net position. That's not a formula. That's simply tracking the changes that occurred from one position to the next. A statement of budgetary resources. The statement of budgetary, the word budgetary tells you I'm in the account code 4000 was that resources equals status of resources. So it's just recapping. So more examples of the balance sheet on page 44, statement of net cost on page 45, and the statement of change in net position on page 46. Page 47 is an example of resources equals status of resources. So that's the statement of budgetary resources. And the final type of accounting on page 49 is managerial cost accounting. So now this is looking from a management perspective. So you have the rest of us doing the budgetary transaction, the day-to-day operation, and then management is going to look at costs from a direct cost, indirect cost. What are those other areas in which cost is generated? So the definition on page 49, the second paragraph, defines managerial cost accounting as the process of accumulating, measuring, analyzing, interpreting, and reporting costs. Managerial cost accounting is a basic part of the financial management system in that it supports and provides data to the budgetary and financial accounting functions and by itself provides useful information for both internal and external uses. So, good data. The key thing on the managerial cost accounting, page 50 and 51, talks about ratio analysis. Current ratio versus the quick ratio or asset test. And they are explained on page 51. So know the reason why we will use current ratio, which is your cash plus accounts receivable plus your inventory divided by current liabilities. And if you read through on page 51, it says the current ratio is the measurement of all the things I've just discussed because it is a measure of liquidity. How fast can I liquidate these inventory, the accounts receivable, in order to pay my bill? The quick ratio is the difference between the current and the quick ratio is the quick ratio does not include my inventory. A test of an entity's immediate solvency. So difference between liquidity, I have time to sell off things. Solvency is not looking at my inventory, but I need to be able to sum of cash and age accounts. So I need the cash. I need money right now to take care of my bill. So that is a ratio is a quotient. So ratio is typically one number divided by another. You know how that is a quotient. The first is trend analysis. And then it talks about the second is comparative analysis. So make sure you know the difference between page 50 and 51, the current ratio and the quick ratio or asset test ratio. So this concludes the accounting portion of module 3. Ensure that you utilize the resources at the back of the section in exercise 3.3.1 on page 53. And I think that's it on page 53 because it has a scenario where you have to identify the account by the account number, whether it's an asset, proprietary, budgetary, whether it's managerial, whether it's an asset, liability, net position, and so forth, or whether it has a credit balance, debit, or both. So ensure that you do that. And then the bottom of page 53 goes into when we talk about the flow of funds from when Congress appropriates the money till that bill is outlaid or paid, the payment is made, what are the type of accounting entries required? And just remember I said the first one, appropriation, is budgetary and proprietary. And the last two, which is receiving the items and paying for it, requires for both proprietary and budgetary transaction. And the rest is just budgetary entries. So we're keeping our checkbook in order. So thank you for sharing and thank you for attending the CDFM study group. And I hope to see you again next time.